Hello, everybody. Stephen Mead here for Domicile Real Estate. This is our Southern California market housing market update for August 31st, 2021. Kind of an interesting week. I actually love it when the data is a little bit of a mystery, because I have to sit down and I have to think for a bit and kind of read between the lines. And one of the things is that we often compare, right, what I hear anecdotally from colleagues and then what the numbers say. And it's always interesting that more often than not, those two experiences are actually very similar. And that's usually a sign that we're doing great on the numbers. The market was cooling for a bit, and now all of a sudden over the last few weeks, it feels like it isn't. I still think the market is actually cooling a little bit. And I'm gonna tell you a few of the reasons why as we go through the data. Also, at the end, definitely watch until the end, because I had a real interesting conversation with a financial planner yesterday, and it got me thinking and running some numbers and talking about interest rates and how we think that might affect the housing market. So definitely stay tuned to the end. We're going to go over that. Let's jump into our statistics here. Alrighty, not sure why we have a picture of a watch, which is admittedly cool up here, but not what we need. Alrighty, so we're going to go back up here. You know what? I think this is actually our wrong slide deck. Let me go ahead and get our correct slide deck here. There we go. There we are. Now we have the right slides. Okay. So, one thing I mentioned is it looks like the market is tightening again and getting more competitive. And we've got a good amount of data that supports some of that, right? Like if you look here, total active inventory dropped the last 2 weeks, and both are under 1 million and are $1 to $2 million price categories. I think that what we might be seeing is a little bit of a seasonal effect. If you have children, if you know anyone who have children, I'm sure you have probably heard people are talking about going back to school. What is the one period of time that people really don't like putting their houses on the market? Well, it's when they're going back to school, and it is between the Thanksgiving and New Year's holidays. So we always see a little bit of reduced new inventory coming in the market. So if you look here, I think this really kind of tells us what's going on. We saw this jump here, and the reality is we haven't seen this. If you except for around the 4th of July weekend, this is the worst weekend for new inventory on the market. The first week or 14-day period since all the way back in February in our under 1 million category. And I don't think that is a market move. I think that is a timing issue. It is no coincidence that this lack of new listings is very close to what we saw back in the 4th of July weekend. So I think there is definitely some timing affecting this. Even over here, we don't see maybe quite as dramatic of a decline, but definitely a decline just the same in that $1 to $2 million price category. And the reason why this is important is if you look at our demand, right? And I think it's really important to make this distinguish between supply and demand, because these two things interact. But what I'm seeing here is that this effect, I believe, is temporary. I do not think that this is a permanent effect. Now, if we go back here, we see a slight uptick in demand, but the reality is, look at how steady this demand has been since back in June, right? Since the beginning of June. I mean, we have now gone through 3 months, and this amount of demand has remained largely the same. Not a lot of huge movements. Again, we did see a drop around that 4th of July weekend. But here's the problem with this, right? And I think home buyers are much less affected by holidays than home sellers are. Putting your house on the market can be an ordeal, not if you list with us, of course, but in general, it can be inconvenient. And buyers, I think, well, if the right house comes up, they want it. So when we look at how does this affect our absorption rate, look at what happens. We approach that magical 90% mark here with our under 1 million, which is kind of the border of intense demand, right? But I don't think that this is necessarily a real figure. If we look in our $1 to $2 million category, again, very, very strong demand. Again, I think part of that is being driven by this lack of inventory that is largely a result of timing and back to school. So I think that that's maybe artificially inflating this absorption. I do think it is still a very strong market. Don't get me wrong. I don't think that that's completely fake, but I think this kind of, momentary period of time when we're back to sort of 20 offers on a listing, I think that that is a temporary situation. I don't think that that is going to last. That's my opinion, but that's kind of what I'm looking at with the data. Now, if we look at the pricing data, I think this is kind of interesting, right? Because again, pricing data is always 4 to 6 weeks old. But if we look here at the upper end of our price range, I mean, really, we've been kind of floating in the same spot. We saw kind of a little bit of a big uptick here in our sort of luxury market, our 75th percentile. But look at our median. Our median has kind of had a very, very gentle increase. This past week it dropped a little bit, but if you look at this trend line, I would call that maybe some gentle increase. And the same thing here on our 25th percentile housing prices, kind of a gentle increase, maybe a little bit more of an increase this past week. I don't think any of these are huge moves. These are markets that look mature to me. Like this looks like a normal type of curve that you would expect to see. When you see a market that's just kind of going and sort of leveling off like this. Now, this is another thing that's a bit of kind of our competitive benchmark, right? Is this percent still active after 14 days? And again, lower numbers mean more competitive. And you see, look, both of these dropped in this past week. Again, I think this is a result of seasonality. If you suddenly turn off, if you've got a bunch of people, taking water from a pool and you suddenly switch off the faucet, what's going to happen to that pool? It's going to drop down. And I think that's the reason why you're seeing this sort of competitiveness of these houses getting snapped up, right? The ones that are just hitting the market, because honestly, we haven't had nearly as many hit the market. Now, this is one that again leads me to believe that really where we're heading is kind of this market that kind of jumped up in the spring, and now it's in kind of much more of a steady state kind of inflationary level increase, right? And that's looking like 3 to 5% a year. This is our close versus list price. And again, I do have to tell you, this is 4 to 6 weeks old, this data, because it's based on actual close data. But look what's happened exactly as we predicted. Guess what? These close prices are getting closer and closer to list price. Does that mean prices are falling? No. What it means is that finally that disparity between what sellers think their house is worth and what buyers were willing to pay, that is narrowed. And I think it's largely narrowed by sellers suddenly being willing to price higher. So they are on average getting closer to their list prices or exceeding their list price less. So these list prices are closer to reality than they were before. Again, there are a lot of geographic factors. So in your local market, you may actually find you're seeing price decreases. I know it's my favorite one to pick on, but it's that San Fernando Valley market where we see kind of what I call insane asking prices, and then the houses get lowered and then they sell kind of for where they need to sell it. I think in markets like Orange County, suburban Orange County, we're still seeing sellers be a little more cautious with their pricing. They're not being as greedy, but we are also seeing that, there is a bit more reality. I think the sellers have figured out they can get a little bit more for their houses. And that's why we're seeing these closes are coming closer to that 100% figure. Now, here's the other one that leads me to believe we are heading into a steadier market. And I'm going to take a second and talk about how do we calculate this days on market figure, because I think it's really important to understand how do we get, where does this come from? This is days on market for new contracts. So we look at all of the homes that went into escrow, the ones that are actually getting buyers. How long have those homes been staying on the market when they get that offer? And when we look at that figure, we do see, I'm comfortable looking at this graph, looking at the big one. We bottomed out, we were kind of flat. Now it's rising very, very gently. Same thing in our $1 to $2 million price range as indicated by the red graph. It bottomed out and now it is rising very carefully. Now, of course, I still want you to look back here and understand Take a look. We are still very, very far from where we were last year. Way, way, way below. So don't think that this is by any means a soft market, because it is not a soft market. But when we see this number start to creep up a little bit, what does that tell me? Well, it tells me a couple things I think are going on. Number one, buyers are being pickier, meaning if you have a crummy house, unless it is priced to sell, those buyers are going to, skip past that house. Number two, it's telling me that we might not quite be seeing as many offers on the listings. This makes sense. Overall inventory is quite a bit higher than it has been, right? So all of this makes sense that these numbers would go up a little bit. They are still very, very low historically, as you can see by this graph, but that's this direction. Is we don't have a cool market, but we have a market that is not as hot as it was. And I think this is a bigger trend. And as I've said on multiple occasions, I'm actually very comforted by this. I think a market that looked like this spring was a very unsustainable market. And I would be very, very afraid if we were still in that kind of a market. Moving on, we've got our affordability index. And, again, this is the thing that gives me a lot of hope. And, I'm going to go off screen share because there's something that I want to talk about for a second that I think is very, very, very important. So before I get into that, we've just been hovering in this kind of 110 to 120% range. Right now, it's right about 112% of where the payments were in June of 2018, right? Looking back to that June 2018 level of affordability, the payment on a median priced home, looking back to that, we're really not that far above that data point. And I think that's what gives me comfort that we are not setting ourselves up for a crash. Now, I'm going to go off screen share a second because I kind of have something fun that I wanted to talk about here. I had a great conversation with a financial planner, my financial planner, actually, who said, "What do you think is going to happen to home prices, and what do you think is going to happen to interest rates?" So, I did a little bit of math, right? Because I think this is always surprising to people. So right now, Freddie Mac's 30-year fixed rate national average is about 2.875%, right? And if we apply that to our sort of our median home price, right? We'll say $800,000 to make the math easy. What happens to the payment on a median priced home if the interest rates jump from 2.875% to 4%? So mind you, that is a 39% jump in interest rates if we go from 2.875 to 4%. Well, it turns out that the total payment, including insurance and taxes, only goes up 11%. So if we're going to head back into that graph, right? If we're going to take another look back at that graph here, where would that put us? Well, if we moved up 11% from here, where does that put us? We're at around 112. That put us around 123, right? I think that is a little on the high side. So one of the things that I think is imperative to understand in any interest rate increases is what really matters here is the speed with which those rate increases happen. If we're talking about real dollars, right, real money, what does an 11% payment increase look like on that $800,000 median priced home if you're putting 20% down? Well, in reality, if we're using real numbers, that means we go up $400 a month. So we go up from $3,589 to $3,989. So it's a $400 increase roughly. I don't think that's that hard to absorb if that happens slowly. If that happens in a period of a month, I don't know. I think prices might have to readjust, possibly downwards 5%. Not really a huge reduction. Going back to this graph again, if we were to see interest rates, if we were to see the payment go up like that, if interest rates went from 2.875 to 4%, but house prices fell by 5%, where would that put us? Well, that would put us right about here on the graph. And we've actually already been in that zone before, earlier this year, back in June of this year, we were already in that 128% range. I thought it would be fun, just for argument's sake, to say, well, what if interest rates go to 5% from our 2.875? What happens to the payment on a median priced home if prices remain the same? Well, that payment actually goes up 22% from where they are today. That is a pretty big increase, right? Like that would be a jump that I think we'd have to contend with. So here are the factors that you need to think about when you're kind of doing this analysis. Number one is the speed with which this goes up. I don't see any presidential administration or Congress being thrilled with having a 22% increase in housing payments. I don't see it happening. I don't see either of those bodies, either the White House or Congress, allowing that. And the reason being is I don't think anybody wants to be an elected official that kind of sees that kind of price increase. I just don't. What's really important is to watch where wages are and how fast wage growth is. If we have positive wage growth, that actually allows interest rates to move up quite a bit and then not really affect the actual affordability of housing. I think watching that wage growth, watching inflation, and watching the speed with which any interest rate increases come. You know, the general logic at the beginning of this year is we thought that by the end of 2021, we'd be looking at something in the 4%, 3.5% to 4% neighborhood for interest rates. You know, we still got 4 months left in 2021. That could certainly still happen. Like I said, I think going from where we are now, which is 2.875 to 4%, I actually think our market has a decent amount of resiliency to largely absorb that without a huge amount of price decreases. I think that will definitely sort of focus in buyers. The houses that are attractive will sell, and the ones that are not will not sell. I think you'll see that absolutely come into play in the market. Anyhow, I hope that's not rambling too much. Questions, comments, we absolutely love them. Definitely send them in. Don't forget to like, subscribe, hit the notification bell, give us the thumbs up. This is our whole market update. We also do a entry-level first-time homebuyer market update that comes out on Fridays. And we also have some other videos that we don't broadcast on Facebook. They show up at other times during the week. So really, if you're watching us on Facebook, subscribe to our YouTube channel. If you're watching us on YouTube and you're not subscribed, subscribe. That's how you see the extra videos. Anyhow, we will see you again later on this week. Thank you so much for watching.